It is a busy Monday on Wall Street. JPMorgan Chase officially won the bidding to acquire the majority of First Republic in an emergency government-led intervention. First Republic now ranking as the second largest U.S. bank failure in history. This is coming ahead of an extremely busy week with a crucial Fed meeting, jobs report at the end of the week, and another 157 earnings reports on deck. For more on what to expect, we have Jennifer Lee, BMO Sr economist, joining us now. So, Jennifer, let's get right into it. What are you expecting in the week ahead?
A lot of activity. Good morning to both of you. And definitely the highlight will, of course, be the Fed meeting, how dovish or how hawkish they're going to sound, what signals they're going to be sending, especially during the press conference will be highly anticipated, I think, followed, by, of course, by the jobs report.
And so for the news that, of course, has permeated from Sunday evening into Monday morning, as it should, considering the magnitude of what just took place in not just the receivership, but then the ultimate sale of First Republic Bank or parts of it to JPMorgan. Does that change the Fed's conversation at all from your perspective?
I don't think it will, because, if it was the very first bank, then perhaps it would. But, it showed that the Fed, during the last, when SVB went under, they had their meeting in the midst of that crisis, and they sort of kept, their heads cool, and they focused on the ultimate goal, which is, keeping inflation or bringing inflation down. And I don't think that this is going to change it much. It just shows that this whole crisis, all this banking turmoil is not over yet. And we're going to have to see how this plays out in terms of financial market reaction, of course, and of course, credit availability from the banking sector as a whole.
So, Jennifer, let's widen it back out a little bit. What's your view on the current state of the U.S. economy, and are there any indicators that give you cause for concern?
So right now, I find it kind of interesting that, for example, last week with the U.S. First quarter GDP figure of 1.1%, definitely below expected. But I feel like we're always pushing out that start of that recession. At one point last year, everyone thought that it was going to be kicking in 2022. And now we're moving it into, or we have moved it into the second half or the midpoint of 2023. And that hasn't changed our goal or our view at all. Certainly all indications are pointing to that slowdown. It's already happening. I haven't seen a lot of indications pointing to a very hard landing just yet, but things are slowly slowing, which is totally as expected after almost 500 basis points of rate hikes. So you have to believe that this is going to happen. And whether or not it's going to be a hard landing or a soft landing is a different question. And we're still looking for a mild contraction for the entire year.
Does that slowdown and kind of the rate by which it is happening, from what you were mentioning a moment ago, does that then prolong the type of recession that we do see?
In many ways, it does. I mean, I think overall it shows the resilience of the U.S. economy. Again, any other economy would have, I don't want to say collapse, but it would have been hurt a lot more, showing a lot more blood, I guess, at this point after so many rate hikes. But the fact that the U.S. economy continues to grow, the U.S. consumer remains very resilient. Again, slowing down the pace of spending, which is completely to be expected. But the fact that they are still, putting a little bit of money aside for a rainy day, jobs are still very strong, I think speaks to overall resilience of the U.S. economy. So this is why we're sticking with our base case scenario of a mild contraction in the second and third quarters of the year before things start to pick up and improve a little bit in Q4. So we're looking for about 1% growth for all of 2023.
Okay. And then is your base case still no rate cuts until 2024?
That is exactly our base case scenario. I think rate cuts would be way too soon. Why give up all of this hard work of bringing inflation down to current levels of about 2-year lows right now for the headline? Why give that up so quickly starting with rate cuts? So we still see this. We expect this Wednesday's announcement to be the last in terms of rate hikes. So just bringing the Fed funds rate up to just over 5%, but still keeping rates at that, or keeping policy at that, those restricted levels. And then we don't see rate cuts being part of the narrative until early 2024.
And okay, so early 2024 for a lot of execs that are just trying to wrap their head around the environment, the macroeconomic environment that they've continued to cite over the course of earnings season after earnings season for what feels like almost a year now. That uncertainty still lies ahead. And so what is the reality of what the business environment looks like, given that they're going to be really mired by this uncertainty for the foreseeable future?
This uncertainty, obviously it's a difficult job, clearly, but at least they are still dealing with, again, resilience. They're still seeing demand. Demand has slowed, which again is completely as expected. So there's still a lot of demand within the U.S. borders. There's still demand coming from overseas, but it just slowing. So just being able to meet all the new orders, even though they are also slowing. Job growth remains quite robust still. So at least you have to make sure that your labor force is as present and accountable and filling up all those job openings that you still have on your payrolls. So I think facing that, but again, facing slower growth as an environment of higher rates, but at the same time, you have to recognize that inflation is also coming down, which is helping matters, I think, a lot for all parties involved. So that is certainly the positive news of all this, again, after almost 500 basis points of rate hikes.
Jennifer Lee, BMO Senior Economist. Jennifer, always a pleasure to grab some of your time and get your insights and perspective. Thanks so much.